Welcome to Success Series. In today's tutorial, we'll be looking at IAS 37, Provisions, Contingent Liability, and Contingent Assets. Let's pick each of the term in the heading into more perspective. Now let's begin with provision. Now, according to the standard, provision is a liability of uncertain timing or amount. Now, in the definition, a key word has been mentioned which is addressed by the Conceptual Framework for Financial Reporting 2018, that is liability. Now, according to the Conceptual Framework 2018, liability is a present obligation of the entity to transfer an economic resource as a result of past events. Now, past events can create two types of obligation. We have the legal obligation and the constructive obligation. Now, legal obligation arises from legislation, a contract, or any other legal act. Now, when we talk of constructive obligation, it arises from business practices or customs that have created an expectation in other parties to fulfill an obligation. Now let's look at when we are required to recognize a provision or the criteria to look out for when you need to recognize a provision. Now there are three criteria for recognizing a provision, and these are: the first is that there must be a present obligation as a result of a past event. The second is the outflow of economic benefit to satisfy the obligation must be probable. So the outflow of economic benefit to satisfy the obligation must be probable. This implies that the likelihood of the event should be more than 50% chance of occurring. Now the third is that the amount of economic benefit required to satisfy the obligation must be reliably estimated. This means that we must be able to mathematically ascertain, or we must be able to get a figure or an amount to represent for a provision. Now there are certain things we need to note over here. Now, in the absence of any of the three criteria, one is expected, or you are required to either disclose a contingent liability or you do nothing if the outflow of economic benefit is remote. Now let's look at how to measure a provision. Now, in the third criteria, we said the amount of economic benefit required to satisfy the obligation must be reliably estimated. So here, this means that we must be able to measure the value that we intend to use as our provision. Now, how do we do this measurement, or how do we measure a provision? Now, in order to measure or to get the amount of provision, you should use the best estimate of the provision at the end of the reporting period. Now, in ascertaining the best estimate, we need to take into consideration some important variables. The first is risks and uncertainties. This may include inflationary periods and the others. Now, the second is time value of money. And then the third is some probable future events which may occur. Now, under how to measure a provision, we have two basic methods of measuring a provision. These are the expected value method and the most likelihood outcome. Now, with the expected value method, that one looks at you using a range of possible outcome of provision. You using a range of possible outcomes to ascertain for your provision. And with the most likelihood outcome, here we say it is most suitable in the case of just a single obligation. Now, how to account for a provision? So here we are trying to just look at the double entry principle in how we intend to recognize a provision based on events which may occur in a transaction. So let's first pick the first scenario or case. So the first case is in a case whereby we are recognizing a provision. So in the case whereby we are recognizing a provision for a first time, one needs to debit expense and then one needs to credit liability. So here we debit your provision as an expense in your profit or loss, and then you credit it as a liability, which will be shown in your statement of financial position. The second case is that when you're unwinding the discount. Now remember, unwinding the discount comes into being whereby your provision is having a long term. So in this case, this provision which is having a long term will accrue an interest, and therefore we need to account for this interest. Now how do we do the accounting? We need to debit finance costs and then we credit liability. Here we are debiting finance costs here is because the interest here, we are going to recognize this interest expense in our statement of profit or loss, and its technical name is the finance cost. Now this same interest will be also represented in our statement of financial position as owings, and therefore we need to credit liability. Now let's look at the third case, when you are using a provision. So when you are using a provision, we need to debit the provision that we are recognized as a liability, and then we'll credit cash or bank. So where we debit liability and then we credit cash or bank. So we debit the provision liability that we have recorded already, and then we credit cash or bank. Now the fourth case that we need to look at is reimbursement. Now in the case of reimbursement, you just need to debit the reimbursement asset with the amount given, and then you credit the expense, that's the provision expense. Now let's look at provision in specific circumstances. Now the first circumstance you must know is future operating losses. Now in the case whereby you have a question whereby you have future operating losses, don't make a provision for future operating losses. You don't account or make a provision for future operating losses. The reason is that future operating losses, it does not result from past events, and therefore does not meet the criterion for a provision, so we don't consider that. The next circumstance that we need to consider is onerous contract. When we talk of onerous contract, it's a contract in which the unavoidable cost of fulfilling the contract exceeds the benefits that you need to get from the contract. What this implies is that the obligation that one needs to perform in a contract far exceeds the returns or the benefits that person is entitled to. So here we said, how do we then account for a provision in the case of an onerous contract? Now, accounting for a provision in the case of an onerous contract, you need to take the lower of the unavoidable cost and then penalty. So you pick the unavoidable cost and then penalty. Now let's move on to the third circumstance. The third circumstance is restructuring. Now we talk of restructuring, it means it's just a plan of management to change the scope of business or a manner of business. So here it means that we are restructuring, we are just changing a pattern of how we do our stuff in the organization. Now how do we then how do we then account for restructuring? So we account for restructuring, or we make a provision for restructuring only if certain criteria are being met. Now the first criteria is that there should be a detailed formal plan for the restructuring with relevant information in it. So yeah, a plan must be drafted by management, and within that plan there must be a relevant information in it on how it intends to embark on the restructuring. Now the second criterion here is that there should be a valid expectation related to restructuring that has been raised in the affected party. What this basically means is that the parties involved must be announced or must be informed about this restructuring. So these are the two criteria for restructuring, and that will end our discussion for the provision aspect of the standard. Now let's move to the next aspect, which is the contingent liability. Now, what is contingent liability? Now, understand that the standard says contingent liability is either a possible obligation from past event that will be confirmed by some future event. So here they use the term possible obligation, where and possible obligation here means less than 50% chance of occurring. So here you have a less probability or less chance of it occurring. Then we have a second definition, which is or a present obligation from past events, but either the outflow of economic benefits to satisfy this obligation is not probable, and then the amount of obligation cannot be reliably measured. So the second definition is informing us that it can also be a present obligation from a past event, but here the outflow of the economic benefit to satisfy that obligation is not probable. That means that less than 50% probability. And here the second one is that the amount cannot be reliably estimated. So one cannot reliably estimate that amount. Now we need to take note of something very crucial here. Now we don't recognize a contingent liability. No, never recognize a contingent liability in your books. What we only do is we only disclose them in our notes. It is being disclosed in notes, but we don't account or we don't recognize it in our statement. Now let's move on to the last aspect of the standard, that is the contingent asset. Now, what is contingent asset? Contingent asset is a possible asset arising from past event that will be confirmed by some future event, not fully under the entity's control. Not fully under the entity's control. So here, what is basically saying that you may get some asset, but these assets are possible. Remember, when we say possible, it's less than 50% likelihood, and here they are not under the control of the entity. So here it doesn't then meet the criterion for even assets per the conceptual framework. So with this and looking at the variables present in the contingent asset, it doesn't qualify for us to recognize also in our statement. So the only thing we just do is that we only disclose them. Thank you. If today is your first time here, kindly hit on the subscribe button and know how to be notified with our new videos.